know why private equity buyout funds have high investment returns? Let's walk you through the journey of this financial learning, so brace yourselves because we're going to cover all the questions going on in your head right now. Private equity is the big name in the world of finance. It's all about putting your money into private businesses, not the ones you see on the stock market. Private equity companies are like the financial wizards who work behind the scenes. That's a lot of money they get from rich investors, pension funds, and even grant money. Then they look for companies that look good but aren't public yet. Like treasure hunters, they're looking for those gems that haven't been used yet. When they find one, then they buy a big piece of the business. But there's a catch. Private equity groups don't just want to make money quickly, they plan to stay for a long time. They help the business grow and make more money by giving advice and support to the people in charge of the company. Let's zoom in on a specific niche within the investment world: private equity firms with a focus area. We all know that private equity means putting money into privately owned businesses, but not every private equity company casts a wide net. Some of them come in very clear. They've done their research and they know everything there is to know about a business. Why do they do that? It's kind of like being very good at a game. You have a better chance of winning if you know the rules, the players, and the tactics better than anyone else. A focus area is an area where private equity firms think they can make better business decisions and get higher returns by learning a lot about the industry. It doesn't mean they only want to be successful. They still have risks just like any other purchase, but because they're more experienced, they have a better chance of making it through those rough waves. That means there's probably a private equity company out there that specializes in what you're looking for. They're not just investors, they're also experts in the field who also work with money. Private equities become a more popular way to invest because it offers good returns, business knowledge, and a long-term view. This is true even though most companies are still privately held. Private equity is likely to stay important and well-known in the financial world as long as buyers keep looking for ways to diversify their investments and make more money. Selling your business to a private equity or PE firm might seem like a good idea, especially if it's in the sweet spot for PE investments. But it's very important to think about the effects and possible outcomes. To make sure the shift goes well and fits your personal and business goals, you need to find the right PE partner and fully understand the terms of the deal. Private equity buyout funds are the engine of high investment returns. How? Let's find out more. Because they can make a lot of money, private equity buyout funds have become a strong and appealing force in the world of finance and investing. The high investment returns of these funds are due to the fact that they buy privately owned businesses, make them run better, and then sell them for a profit. In this part of our in-depth look, we'll break down the different things that make private equity buyout funds so appealing, showing why they've become such a popular choice for investors looking for big returns. Number 1. Taking active ownership and improving operations. One main reason why private equity buyout funds have such high investment returns is that they actively own and run the businesses they invest in. Private equity firms take direct control of the companies they buy and work closely with their management teams. This is different from passive investments in publicly owned companies where investors often don't have much say over how the company runs. Private equity companies can make operational improvements, streamline cost structures, and boost revenue growth with this kind of active involvement. Private equity firms can make the companies in their portfolios do much better by proactively fixing inefficiencies and looking for growth possibilities. Number 2. Financial engineering and leverage. When it comes to financial planning, private equity buyout funds are very good at it. They usually pay for their purchases with a mix of debt and cash. They can increase their earnings with this method called leverage. Most of the time, a private equity fund borrows money to buy a business and spends some of its own money. The assets and future cash flows of the bought company will be used to secure this loan. Leverage makes the returns on private equity investment bigger because any rise in the value of the company has a big effect on the stock part of the investment. When a buyout goes well and the company's value goes up because of better operations, changes in the market, or strategy decisions, the private equity investor can get a lot of money back. Number 3. Focus on creating value. It's not just financial engineering or short-term gains that private equity companies are interested in. Their main goal is to make their partner companies more valuable over time. A lot of the time, they work closely with management teams to make and carry out long-term, growth-oriented strategic plans. When a company focuses on creating value, its products, customers, and place in the market can all get a lot better. It could mean going into new markets, making the supply chain more efficient, or coming up with new goods or services. These efforts make the company more profitable and, in the end, more valuable. Number 4. Attractive entry valuations. A lot of the time, private equity buyout funds look for companies that are cheap or have growth potential that hasn't been fully realized yet. Because of this, they can buy businesses at good entry prices, giving their capital a safety margin. When private equity firms buy companies below what they're really worth, they might be able to make more money when the companies do better. Number 5. Exit strategies and timing. Private equity buyout funds always have an exit plan in mind. They have a set amount of time to invest, usually between 3 and 7 years, during which they want to increase the value of the business. They plan to get out of the investment in a number of ways once their goals are met. When private equity firms carry out their exit strategies, they try to take advantage of strong company growth and good market conditions. They can get the best returns for themselves and their clients by planning when to take these exits. Number 6. Knowledge of the sector and industry. Private equity companies usually focus on certain industries or sectors and use their knowledge to find good investment opportunities. Private equity companies are better able to make smart investment decisions and make more money when they focus on areas where they have a competitive edge. Number 7. Diversifying your portfolio. Private equity buyout funds are becoming more popular among investors as a way to spread out their holdings. Diversification can help lower risk and improve the total performance of a portfolio. It's important to keep in mind, though, that private equity assets aren't very liquid and usually require a longer-term commitment. Before putting money into these funds, investors should think carefully about how much danger they're willing to take and how much cash they need. Number 8. The ability to handle risk. There are many ways that private equity companies manage risk to keep their investments safe. Before buying a company, they do a lot of research to find out what risks and opportunities might be there. They also often try to get good terms and covenants written in the financing deals to protect their investments and lower the risks of going bad. For buyers who want to get a lot of money back, private equity buyout funds are a great option. Their focus on creating value, active ownership, operational skill, and financial engineering all make it possible for them to make huge returns. They're also more appealing because they specialize in certain areas, have diversified portfolios, offer good entry prices, and match their interests with those of their investors. But buyers should also know that these investments are hard to sell. There's a chance they won't do well, and market cycles can affect them. To get the best chance at high returns while minimizing the risks, it's important to choose the right private equity fund with a track record and a clear investment plan. In the world of private equity buyout funds, as with any investment, the key to success is to do your research and think about the long run. If you found this video insightful, don't forget to give it a thumbs up, share it with your fellow finance aficionados, and of course, subscribe to our channel.